These two here mean kinko, which is balance from a mountain. That's what that one means. And the final one is chart, which is also the word for footprint. That little picture there means a footprint. And so generally what it roughly translates as is a balanced instant view as taken from a mountain. That's what it means. And the guy who invented this is a chap called Goichi Hosoda, whose pseudonym is Sanjin Ichimoku. And he devised this system in the 1960s based on the Tokyo Stock Exchange share prices, and it was based on trial and error, laborious backtesting, and let's not forget we didn't have computers in those days. He took on these trainees, not interns but trainees, and swore them to secrecy. And the whole thing sort of went quiet for a while, but then in 1995 Hidenori Sasaki wrote a book about the subject, and that really boosted its popularity in Japan. Of course, I have the book, of course, and my kind Japanese colleagues little by little helped me work my way through the book, and it is today one of the most popular technical analysis books in Japan. Right, what are we going to do? The first thing to do, just to let you know, I'm going to plough my way through the system so that you can learn it, and then I will stop and I'll take questions later, please. All right? Questions will be later. So the first thing to do is plot the daily candlesticks on the chart. I'm assuming you're all au fait with candlesticks. If not, may I suggest you go to the expert on the subject, which is Steve Nyson. With these candlesticks, you're looking for conventional Western patterns, like, for example, a triangle that we've got there, or a little rectangle consolidation as there, or a potential double top as there. But you're also looking at the candles themselves, which have their own special patterns, like that one there. Okay, that one there is a little doji. All right, this one here is a big Marubozu. And here again you've got a little doji and a greystone doji. Do learn about these, they're very useful. Okay, also just to let you know, the trading of commodities and futures is nothing new. These candlesticks were started by a trader on the Osaka Rice Exchange in the 1700s. He was very successful trader. He invented the candlesticks in the 1700s in Osaka. And let's not forget that we were trading in Amsterdam options on tulip bulbs in the 1600s, and we have been trading agricultural commodities in Chicago since the 1970s. So, you know, trading and using charts for this is not new. It is not a new science. What we then add to the candles are two moving averages. These were devised with, as I say, back-testing, quite frankly, just trial and error. And it was found that the best ones to use on a daily chart were the 9-day moving average, which is this pink one, which most closely hugs price action, and then the 26-day moving average. The reason I think the 26-day moving average is particularly good is that in Tokyo they used to work Saturday mornings on the stock exchange, and so the average month has 26 working days in it. The moving averages are a crossover system. It is a trending system. You are always in the market, always. When the 9-day is above the 26-day, you are long. When it drops below it, you are short, and you are long, and it looks as if they're about to cross over here again. In other words, you've always got a position. But because it's based on moving averages, it does not work at all in sideways markets. You will be guaranteed to lose money if the market is not trending. So Ichimoku Cloud charts are to be used only in trending markets. How you decide whether a market is trending or not, I leave that up to you. All sorts of people have different ways of scaling in and scaling out of positions. I urge you to think about these. Okay? So there we are. I think that's pretty simple so far. Now this is where it really gets interesting, and this bit here is the cloud. This particular system has it pink when it is going up and turquoise when it is going down. It doesn't actually matter. But first of all, how to calculate this upper line? This upper line is the 9 and the 26-day moving average that we saw on the previous slide, added together and divided by 2, and plotted 26 days ahead of time. Okay, so based on the two moving averages that you see, right, which come in at 104.19 and 104.01, okay, these are added up and divided by 2, and they come in at just above 104, in fact 104.10 to be precise. It's over there, can you see? Can you see that over there? That's that sort of rusty brown line at the top. So that is that, those two, average of those two, plotted 26 days ahead. Again 26, remember that, keep that in mind. Okay, now the lower line of the cloud, called span B, that's span A or line A, that's span B. It's completely different. It's completely different. Its calculation is as follows. You look for the highest price of the last 52 days, in other words, as at here, go back in time and find the highest price of the last 52 days, which will obviously be that one there. And then to that you add the lowest price of the last 52 days, which will probably be that one there. You add those two together and divide by 2. And that comes in here at 101.40. 101.40 is the average price. And because often a low stays there for a very, very, very long time, and a high remains in place for a very, very long time, what you'll tend to see with this line is that it goes flat for ages. And here it is over here, flat for ages, and again here, flat for ages, and continues flat for a very, very long time. Can you see that? In other words, you've got an absolute outlier of a high and an outlier of a low, and those dominate for days and days and days until eventually they drop out. Okay? Now, what this is just like the moving averages are suggesting a long or a short position, depending on how they lie, so too the cloud, if it is rising, suggests a long position, particularly so if the candles are above the cloud. So this is giving you more layers and levels to consider, not only as to whether you should be long or short at all, right, but where your support and resistance levels will lie for today's trading. Okay, so here I think you'll agree that the averages, while they have been keeping you long all the way through from this point, might be beginning to cross, and you might begin to reconsider whether you still want to be long. Looking at the cloud, however, that is resolutely bullish, and you'd say, well, actually no, my cloud still suggests I should stay long. Maybe, seeing as I've got mixed messages, I should stand back and see how it pans out. And certainly that would have been the case here, yeah, where your averages were long and yet you were trading under the cloud, yeah, suggesting you should be short. So possibly at this point here you would have stood to one side and see how it worked out, and then 2 days later they were all aligned for a bullish position. The moving averages themselves provide support and resistance to today's price action. So you'll see that that green line is providing support today. Okay. Meanwhile, that red line also provided support on that day, but resistance here and again here. Okay. Same for the 26-day moving average. It did provide resistance over here, and it provided support on that day there. Can you see how it catches that daily low? Caught it and pushed it higher. Very determined. Likewise, the top of the cloud will provide support for today. So that comes in here at 101, just above 101, the figure. And then again, way, way down, that is your last line of support for the current price action, coming in at 9,750. Okay? So those are 1, 2, 3, 4 levels of support and resistance as provided by the elements of the cloud chart. And now to my final and rather trickier line, and this is very unusual. It's this green one here. It's called the lagging line. It is a line chart of the closing price plotted 26 days ago. So it is this closing price plotted 26 days ago. That closing price plotted 26 days ago. Right? That closing price plotted 26 days ago. And what does this line do? Well, again, this line, it'll give you an idea of where, looking down at the candles, at the moving averages, and at the cloud, where support and resistance for today's price action might lie. So as well as looking down here, that would be your first level of support, your second level of support, your third levels of support, and your fourth level of support based on this setup here today. This one will give you more levels. So the candles themselves become support. Notice here how that supported the move, the rally from that point there. Here it tried to just missed it, but then they caught up. Yeah. So here, today's price action will get support from that candlestick, the top of it, that candlestick, its lower edge, that moving average, that cloud, and that one there will be your fifth and final level of support from this line here and its associated averages and clouds. Okay?